Hello and welcome to GCV Analytics webinar. My name is Kaloyan Andonov and I'm delighted to be hosting today's webinar, which will tackle questions around the life sciences sector. And it is usually in hard times, such as the ones now, that we turn to science for answers and solutions. And it is no different this time with the COVID-19 pandemic, with scientists and pharmaceutical companies working around the clock in trying to find an effective cure or vaccine for the malady that has befallen the entire world. And today's webinar is precisely about the sector which we all look to with much hope to get us back to that old normal we used to know merely 6 months ago. And so we are very excited to be hosting this webinar in partnership with Faegre Drinker, our longtime sponsor, has supported us throughout the years and even in these hard times, for which we're very thankful. And I'm truly delighted to be introducing and welcoming our guest speakers and panelists today. We have Asish Xavier, Vice President of Venture Investments at JJDC, which is the venturing arm of pharmaceutical company Johnson & Johnson. Jasper, Senior Vice President and Managing Director at M Ventures, the venturing subsidiary of Germany-based Merck KGaA. And Matt Stamski, who is partner at Faegre Drinker, and who will be moderating the discussion panel. And along with us, of course, we have our founder and editor-in-chief, Jim Mawson. So welcome, gentlemen. I will take, before we move on to the discussion, I will take a few minutes to briefly go over some of the things that have been happening in this sector. In the health or the life sciences sector, probably one of the biggest themes that we've seen is digitization and datafication, which is something we've observed over the past half a decade, pretty much across all sectors. And in life sciences, broadly speaking, it permeates from things like medical devices to things like digital therapeutics and telemedicine, which may have got another boost from the COVID-19 pandemic and the nearly global lockdown. So these broader trends are expected to go on in the sector. In the pharmaceuticals in particular, on the economic side of things, we have drug pricing and reimbursement issues being seen still as probably the greatest challenge for pharma. And this was, as soon as January this year, according to executive surveys. On the scientific side of things, we've seen an enormous boom in terms of oncology and cancer treatments that are being developed currently, and that have been financed through one way or another over the past half a decade. This does make everyone very, very hopeful, particularly things like immuno-oncology. And aside from that, we've also seen the rise of genomics and potentially gene therapy, gene therapeutics, with a lot of potential, even in instruments like CRISPR, which could unlock enormous addressable market opportunities in the future. Now, within the realm of corporate-backed investments, we do see that there have been fairly stable, as this slide illustrates here, on a year-on-year basis, both in terms of total number of deals we've tracked and the total dollars that were deployed in those deals. It's a similar situation with the exits involving corporate investors, so whether it's acquisitions or IPOs, nearly the same number of exits that we tracked in 2018 and 2019. The total dollars did register kind of a significant drop here. So that was slightly more interesting, but with interest rates becoming well, having become even lower today and likely to stay low, this is probably not as much of a warning sign as it is a sort of a fluctuation we see here. And finally, in terms of the funding initiatives that involve corporates that we've tracked, but we definitely saw a big increase in both numbers and total dollars, which makes it look overall very, very good for the life sciences sector going forward. So with that, I conclude my very, very brief overview, and I'm going to hand over to Jim, who's going to say a few words about our organization. Jim?
Wonderful. Well, let me add my thanks to you, Kaloyan, for being able to prepare the data and organize this webinar session. And I'm super excited to hear the insights from Jasper, Matt, and Asish there in terms of understanding this really most vital sector. I think the coronavirus, in particular, through COVID-19 disease, has really sort of brought to attention just how important it is, the work that everyone does to make the world a healthier and hopefully better place as well. So thanks for that. In terms of why we do this, obviously Global Core Prevention is a sort of trade paper. We try and think about two main questions: who does core prevention and what do they do? That sort of news allows us to track the data, which forms the underpinning of GCV Analytics. All of that's pulled together in what we call the sort of GCV Leadership Society, where we've identified that the top 20% of core prevention units, the M Ventures and the JJDCs of the world, do about 80% of the deals. They're the professional groups that have the understanding and the track records. But by bringing those people together, we allow those best practices to be shared to the 3,000 plus corporations around the world that are engaged in some shape or form in either investing directly in startups or indirectly as a limited partner. Obviously, we do the GCV Academy as a sort of training institution to help the professional standards of the ecosystem going forward. And then the GCV Connect remains the AI piece of the algorithm so that the corporations can fundamentally communicate with each other and swap deals and look at new deal flow as well. And we partner with groups like Proceed or PitchBook and others in order to get that wider ecosystem developed. And then Global Core Prevention is one of the publications that we do. We also do one looking at Global University Venturing, which is the student and faculty startups and spin-outs out of universities, as well as Global Impact Venturing, which is trying to understand the United Nations 17 Sustainable Development Goals and how governments in particular are trying to support and add value to the ecosystem. So that's broadly what we do, as well as doing the sort of the events. We kind of, such as these webinars, we do a number of virtual conferences. We call them the GCV Digital Forum. The next one will be the 29th of September, and live events as they come back, such as the GCV Symposium in London on the 7th and 8th of December, and the GCVI Summit in California, in Monterey, which will be January 27th and 28th. And then we do other conferences around the world, as you can see here. So I won't say too much more. We'll go to the sort of final slide, and that will be my cue to hand over to Matt at Faegre Drinker to kind of start the discussion, and please take it away with my thanks, Matt.
Great. Well, thank you so much. And James, you want to give me a wave if you can hear me okay? All right, there we go. Hi, everyone. So I am so grateful and privileged to be here with you all today. We have obviously a wonderful organization in GCV and just outstanding panelists with Jasper and Asish, gracefully providing their time today. So I am a venture capital and M&A partner at Faegre Drinker, and so I spend my days working largely in the life sciences industry, helping startups raise capital, helping investors deploy that capital, and a lot of my work and my firm's work is in life sciences and representing strategic investors, corporate investors. And I get to say it's an honor and a privilege. We love what we do. It's rewarding. It's fun. It is cutting edge, and really, no more true than now in this time. And so we have about 1,300 lawyers in the U.S. and London and China, and we love to partner with wonderful, aspiring, leading-edge companies to help, really, in this instance, when we're working in life sciences, to really truly make the world a better place, right? And so we, again, we love what we do, and I would love to just have, I don't want to butcher either Jasper's or Asish's bios, and so maybe I'll start with Jasper. Jasper, do you want to just share a couple minutes about who you are and what you do and what Merck is doing in this space?
Sure. Well, thanks a lot, Matt, and of course, thanks James and Kaloyan for having me here. It's a great honor to be here with all of you. I'm Jasper. I'm the managing director of M Ventures. We are the 400 million euro corporate venture arm of Merck, German Merck, and we're based in Amsterdam. I joined M Ventures 12 years ago when we started off as a 40 million euro, very small biotherapeutics investment fund, strategically doing early stage deals for the Merck Serono business of Merck back in the days. Over the years, we grew that from a 40 million to what is now a 400 million fund, from 2 people to what is now more than 30 people. And we typically invest in, I would say, all areas related to biopharma that are strategically aligned with Merck, with our parent company, which is mostly novel treatments in oncology, immuno-oncology, immunology, very much also centered around novel platforms, novel modalities. But of course, we not only invest in biopharma, because like J&J, Merck is not only a pharma company. Merck is actually also a company that is a world leader in life science tools and technologies via Medipore-Signa. And of course, Merck is also one of the world leaders in supplying the necessary materials needed for the semiconductor industry. So we also have dedicated teams that invest in novel computing architecture, that also invest in life science tools and technologies like synthetic DNA, etc. So very cutting edge, and our role really within Merck is to make sure that we are the eyes and ears towards the external world, towards novel blue sky thinking, and to be able to bring that back into Merck. In terms of my personal background, I did my PhD here at the university in the Netherlands in pharmacy, and then I moved over via heading health economics at the Netherlands Vaccine Institute. I moved over to run a smaller private equity fund, and afterwards I've been with Merck for the past 12 years. So thank you.
Well, fantastic and fascinating, and thank you so much for sharing a little bit more about the broader reach of Merck as well. I know that's very interesting to our audience. And so I'll turn it to Asish. Do you want to share a little bit about yourself and the J&J Ventures?
Thanks, Matt. So thanks again to Global Corporate Venturing to give JJDC and me an opportunity to be on this panel. So I'm based in the Bay Area, work out of the South San Francisco Innovation Center. I've been with JJDC for 16 years and now lead biotech investing globally for JJDC. That also includes some amount of diagnostic investing on our part. So JJDC is, I think, the oldest corporate venture capital group, certainly in healthcare, but probably broadly speaking as well. And we have been doing venture capital investing since 1973. We operate out of 6 offices. So we have people on the ground in Shanghai, Tel Aviv, London, Boston, New Brunswick, New Jersey, and New York, which is where our corporate headquarters is in New Jersey, and then South San Francisco. So between these 6 offices, we have 12 investors, and then our back office functions are in New Brunswick. We invest strategically, as Jasper was saying, with respect to M Ventures. So we invest in areas where J&J has either R&D or business units today. So those are, broadly speaking, in drugs, medical devices, and consumer healthcare. So our team of 12 investors reflects that. Our portfolio is about 60% drugs and diagnostics. Almost, I would say most of that is drug investing. Then we have about 25 to 30% medical devices, principally in US and Israel. And then finally, about 10% is consumer healthcare. My background is I have a typical sort of venture capital background, did the usual PhD postdoc, did an MBA, and worked at 2 startups before I joined JJDC in 2004. And over the last 16 years, I have invested in biotech, medical devices, and healthcare services. But since 2012, I've been focused principally on biotech investing. And in terms of dollars, we are not a fund. We are investing off the balance sheet. So since say 2012, once the last recession was over, we have been investing new and follow on average about $400 million a year. So we are among the larger venture capital groups out there, be it corporate or otherwise in the healthcare space. And we typically do about mid-teen number of new investments, lead somewhere between 60 and 70% of our deals.
Great. Well, thank you so much. And again, interesting. And I think maybe later on, I would love to hear maybe you guys kind of compare and contrast the two different flavors, because this is something we experience, having a dedicated fund versus investing off the balance sheet. But we can get to that. I guess I should say one more, housekeeping item. There is a Q&A function on the Zoom. It tends to be at the bottom of your screen, and we would love to hear from you. And so to the extent you have questions, pop them in there. I will do my best to multitask and keep track of those. As you can see, I'm in my home office, resplendent with kids' art and school projects. So if you happen to see a couple kids who are summering at home these days, please excuse them. They might have something great to add, but we'll see. But why don't we dive right in? I mean, I know what's on everyone's minds right now, right? We're in unprecedented times, and I'd love to hear, what our panelists are thinking about, kind of trends and what they're seeing. From our perspective at Faegre, as a law firm, I mean, we have an interesting lens into the market. Obviously, things in March and April, more or less on the deal front, in our experience, things that were hot and topical still got done, but there was a fairly big hiatus as everyone recalibrated. But what's been interesting to me and to our team here at Faegre is that in recent weeks, particularly in the life sciences sector, we've seen a proliferation of term sheets of deals getting either back on track or deals that are getting signed up, and so that's really encouraging, I think. So from our kind of slice of the universe, we're seeing some encouraging signs. But I'll turn to Asish first. I'd love to hear what kind of what trends and technologies you've been observing, and what are you seeing in the market? So I'll turn it over to you.
Thanks, Matt. So I would say this has been unprecedented in the way the industry has come together to face what in our lifetimes is the first major pandemic. There have been other pandemics, but none of them have had the global impact in the last 20 years that COVID-19 is having. And J&J has had a number of initiatives, including a vaccine, which has been fast-tracked and is going forward and so on. We have also had a task force to look into drugs we already market or are in late stage of development, and what they could do with respect to COVID-19. So coming particularly to investing, I think from my perspective, with respect to biotech investing as well as device investing, things have not slowed down, both with respect to investing in new companies, follow-on investing, as well as M&A and IPOs. So from our portfolio, we had an IPO a couple of weeks ago called Legend Biotech, which is a company with offices in Somerset, New Jersey, but started out of Nanjing. So JJDC co-led the spin-out of that company from a Hong Kong listed company called GenScript in Q1 of this year. And then we took it public in June, early June. And the company is worth over $4 billion and trades on NASDAQ and has a phase 2 asset, a CAR-T asset in multiple myeloma. And this week, one of my companies is doing a road show. This is a company in Hamilton, Ontario and Boston, which we led the Series A and helped start. And the company is called Fusion Pharmaceuticals, and it is expected to price its IPO tomorrow and trade on the NASDAQ on Friday. So, from end to end, we are seeing things fairly normal. And I have to admit, in rest of the economy, when I walk around the town I live in Silicon Valley, it's very different, right? Restaurants just started opening about a week ago. And now, people are having street dining with 6 feet distance and so on. So a lot of the economy is affected clearly. But I think in the small slice of healthcare, and especially with respect to investing, things have been fairly normal. And surprisingly, the amount of capital has in a way increased compared to even a couple of years ago.
Great. Well, thank you. That's a really, again, credit to GCV. I mean, we're getting the views of the folks that are really helping to drive and shape these markets. And so, thanks for that kind of insider's look. Jasper, what about you? What are you seeing? And maybe, I don't know if there's anything different from a European perspective, but would love to get your thoughts.
No, I mean, first of all, indeed, I think the pandemic is something like we've never witnessed before, and it profoundly has impacted the way we work and also the way we interface with startup companies and the way we can do diligence. So it's certainly something that affects also the way you take a look at companies. And I would say what we saw in March and April is very much an attitude whenever we have quite a few companies where we are very early investors, where we go out and syndicate it. And we got quite a lot of responses in March from other investors saying, well, we have cash, but we want to reserve it right now much more for our current portfolio, for our own portfolio, because we don't know what's going to happen with this COVID-19 crisis. Right now, what you see is actually that tendency is a little bit over, and we see deals are getting done again. Term sheets are being put on the table. I would also say that if you take a look at the number of funds that get closed and the number of LPs that are still very interested in investing in venture capital, I would say that's still unprecedentedly high. This is, of course, also very much fueled by the successes in the public markets, where there's almost I would say, a discordance between what you can see in public life that Asish also mentioned very clearly. What you see in public life, what happens in global economy, versus what happens on the stock market. The fact that the IPO window is still very much open, and that preclinical or very early oncology companies can now actually still IPO. I think that really points towards a very strong market for early stage biotech. And I think that's the one thing that COVID-19 has done. It's really emphasizing the importance of a proper and well-functioning healthcare system. And you can also see that in something that Kaloyan already highlighted in the beginning, and that is the huge uptick in valuations of certain digital solutions. So certain solutions that allow you to not have to leave your home, telemedicine, etc., have tremendously increased market cap. And I think that's also really, in a way, I think COVID-19 is accelerating this change towards a more virtual way of treating patients and a more, let's call it, a less presence required and face-to-face meeting required new reality of actually trying to treat patients.
So maybe, Matt, one thing is maybe, taking off from what Jasper said, let me highlight a deal we have done, which is sort of COVID related. So we were invested in a company called Q, which is a diagnostic company, at-home diagnostics. So which is very relevant to the situation we are facing here in San Diego, which has a very innovative platform. And the company has now managed to get BARDA funding, and in the last 6 weeks raise $100 million financing in order to drive their products into various channels where they would not have thought of in January of this year, right? So we did participate in that financing we were already, investors in the company, and a colleague of mine sits on that board. But that's a specific deal which sort of addresses a need in the market, which is likely for many months and maybe a couple of years, people may have to do testing at home, testing at a lot of locations where otherwise wouldn't be testing, diagnostically speaking.
Yeah, thank you both. That's fascinating, and I guess perhaps a little unsurprising, but when I love the discussion about the dichotomy between what we're seeing, in our communities and at home, and the vibrancy, right? The vibrancy that's going on in the life sciences market, and particularly with anything kind of digital health and things like that. And that's consistent with our experience as well in terms of what we're seeing. And so, I guess we talked a little bit about kind of stay at home. How do we provision that kind of in the near term? But are there any other kind of very specific COVID-related themes that you're seeing? Obviously staying at home, trying to personalize medicine, things like that. But do you think there are other changes that are going to impact the market, and particularly how you're thinking about your investment strategy?
Mm-hmm. Yeah, I think in terms of impacting investment strategy, I wouldn't go that far, but what I do see is a very much a renewed interest, of course, in basic virology, and really a proper understanding of novel antiviral mechanisms and also novel antibacterial mechanisms. And I think this is an area which has, I would say, been underinvested in for a while. Of course, we have the various hepatitis C treatments. We had a number of other viral small molecules coming to market, being hugely successful. But in general, if you compare it to the level of investment that we see typically in oncology, for instance, this was really a dwarf compared to that. So we do see very much an uptick in opportunities that are related to either vaccine development, novel vaccine technologies, DNA vaccines, but also even novel adjuvant technologies, but also really novel antiviral products. And I think that is something which is very interesting. It's not necessarily within our strategic scope. We tend to focus much more on the oncology side of things. But even there, and this is a general trend, and I would say this is also something that you saw with COVID-19, is the speed with which we can now sequence, the speed with which we can generate insights in modes of action, and the way we can actually utilize big data to gain insights that we couldn't do in, let's say, 3-4 years from now, is really, I feel it's very much accelerating by crises like this. Because in times of crisis, it's exceptionally important that you get information, that you use digital tools, and that you're able to use, for instance, AI for drug discovery. We're now very seriously looking at that field because we realize that certain actually data mining tools, artificial intelligence tools are actually very well suited for finding hit compounds and finding patterns very, very quickly. And that can revolutionize the way we actually develop drugs. So I think that's the relation that I would see. Other than that, I also, on the skeptical side, see tons of companies that I've seen before. And all of a sudden, they are developing a COVID-19 cure. And we've also seen that we always used to call that the Ebola phenomenon, because when there was an Ebola outbreak, we used to see exactly the same. You get all these companies that reposition themselves all of a sudden, diving into a new opportunity that are typically not very successful in that. So I think that's the skeptical view of things if I take a look at my deal flow.
So Matt, to add to that, one area I think there is going to be significant change going forward, even after COVID, is the impact on telemedicine and the impact on using synthetic arms in clinical trials. And these are things which have been around certainly for a decade or more. With synthetic arms in clinical trials, maybe less than a decade. But clearly there is significant interest both from the larger companies, but also willingness on the regulatory bodies part to make changes to make this happen. Because one impact that has happened to most companies, large and small, who run clinical trials is the clinical trials in many cases have been put on hold. And while some of the trials have restarted, it's still unclear if many of the elective surgery trials and other trials will restart, anytime soon. So having synthetic arms has means of controlling for some of the need for placebo or for head-to-head comparison is an important change that will be probably permanent going forward, or at least part of the thinking of designing clinical trials. And there's a number of companies in this general digital space or data science and AI space who have benefited in a way to accelerate the adoption of their technologies, and therefore is drawing more dollars and more startups. Because this is an area where, especially here in Silicon Valley, you have a lot of similar technologies being used in other areas outside of healthcare. And now people are sort of focused on it because this has been a huge disruption. And people who may not have thought of doing healthcare suddenly look at it and say, this is something I can use my skills in.
Yeah, that's fascinating. Both of those perspectives, and especially the notion of kind of, I really like the notion of, people who maybe were not thinking about healthcare being driven to this market and attracting kind of the top minds and technologists in Silicon Valley and elsewhere. That would be a wonderful kind of halo effect or silver lining, in these times. And I could say from a clinical trial perspective, obviously a lot of the transactions in life sciences are, either staged at the VC level where we're making investments, and, subsequent tranches are dependent on milestones or events, and some of those are clinical trial related. And that has been an interesting area for the lawyers and for the business folks, because we're all in this together, and it's not something that's really within the control of a lot of the startups. And then obviously on the M&A front, when companies are out being acquired, a lot of time downstream payments are tied to those things. So it's these really interesting, insights on that front. And I to that end, you both have really touched on, kind of your approach of working with portfolio companies, but I think our audience would love to hear a little bit more about that. And in particular, maybe I'll start with Jasper. It sounds like you're typically out there looking at fairly early stage, almost first dollar type investments and partnering with them. So I think I would love to hear, I'm curious to hear a little bit more about your philosophy of kind of timing, what you're looking for, and then, how you work with them as these companies continue on their arc.
Yeah, thanks, Matt. That's a great question. I think this really touches upon, the core of what we do is we are typically looking, I think, just like Asish with JJDC, we're looking for game changers. We're looking for novel molecules, novel approaches that can definitely be first in class, where if we finally mitigate all the science and development risk, we have a very well-defined population, which means a biomarker-driven strategy. It means that we're able to actually identify these patients already pretty early on. And from that on, what we would typically do is we would actually work back and we would try to set up the best possible development plan. That doesn't mean that it's the most efficient. It does mean that it's the most efficient in terms of de-risking the opportunity. So that is really what when we identify an opportunity that could even be an academic paper, that is how we start to work. So we see a group of novel targets, we see a novel approach, then this is how we start to work with an academic. And I think a great example is the company we started up this year, which is called Forks Therapeutics. This is based around the work of a Geneva-based academic working at the University of Geneva. And this is, to us, this is the next generation in DNA damage repair. DNA damage repair is an area which is growing tremendously, has super high level of interest, but we believe that this, which is break-induced repair mechanisms, is really the next frontier. Very, very novel. So we worked with the academic for a period of close to 9 months together with Omega, LSP, Novartis Ventures, and Pfizer Ventures in a syndicate where we all pitched in with knowledge, where we all worked together to define a work plan, including certain scientists at Merck, but also at Pfizer, for instance, to really draft a work plan that would make most sense, and where we, with a limited investment of between the 5 parties of in total 10 million, we would be able to actually get to very well-defined outcomes. And I think this is a really nice way of working together with a portfolio company, because we are able to not only provide cash, but also really help the company in physically getting set up. So really founding the company, doing that together with key other investors that we invest with before, simply because we also want to take out that refinancing risk. And this is typically how we think about doing these earlier deals, is really almost acting like part of the founding team. And in fact, we have had a number of portfolio companies where we were part of the founding team, especially when we spun out companies out of Merck. For instance, a company where JJDC is also invested in, actually 2 of them, Calypso and Esseneuron, were really founded that way. It meant that the business plan was written in part by the Inventures team, together with the persons in Merck that ultimately became the entrepreneurs in the company. So I think that is a very interesting way also for my team to work, because it's a great way to learn, because you not only get to lead deals, but you also actually get to be very creative in working together with companies. And because we don't have ownership restrictions right now, we can actually take up pretty high ownership levels right at the beginning, which also makes that much more easy.
So adding on here, we have the same philosophy on biotech investing, which is we really have to go for transformational technologies, platforms, and products, because the size of our companies, both Merck and J&J, eventually things which we onboard from our portfolio or from the larger ecosystem of companies really need to move needle on companies which are having tens of billions of dollars of revenue, right? So these have to be really global, significant opportunities. Giving a slightly different area where we are looking at in the biotech space is J&J has traditionally had significant data science and other opportunities within the medtech and consumer healthcare space, and we have invested in those for wrapping around our products and so on in the last 5 years. We have now started looking in the biotech space, and we should be closing data science investments in the space in the next weeks to a couple of months. And this involves accessing large data sets of real world data in various areas. So one of the things that Jasper said was biomarkers. So looking for biomarkers in these data sets, which would probably allow us to short circuit the amount of time needed experimentally to get to a biomarker for a drug. We are looking at things like tokenization, so you can anonymize patient data and you can compare the data across different sources from providers, payers, and so on. So we won't know the patient, but we will know it's the same person who has been using healthcare in various ways, right? From providers, payers, and other places. Further, we are looking at having software which is able to link to the data sets in various disparate parts of the ecosystem to help accelerate drug discovery. Because at the end of the day, the productivity of R&D in large companies in drug discovery has not been great, and it has actually been going down over the last couple of decades. And so one of the ways that it may be possible to increase the productivity is to bring in both data science and machine learning in order to try to look for insights, because the volume of publications and volume of new science being published and worked on is so huge that it is no longer possible for even the experts in a field to keep up with everything that's happening.
Well, sorry, let me, I can barely keep up with the mute button, so I can't imagine keeping up with the volume of academic papers out there. You know, you each touched upon this, and Asish, I'd like to turn to you, but, you know, when you think about corporate venture capital, you know, when we work with our clients in this space, you know, a question we get a lot from the startups and the community where our clients are investing is, you know, how do you think of yourselves? You know, are you a financial investor, a strategic investor? What are the goals? I mean, I think I know the answer, but I think I'd love to hear from you because, Asish, in particular, you talked about the recent IPO or the imminent IPO coming up. And, you know, we work with some strategic clients who say, well, anything short of an acquisition is kind of a failure, even if they're generating a return on it, right? That's one perspective. You know, I've never heard anyone say, oh boy, we made 10x our money. What a bad result, right? That's not something you normally think of, but, you know, we do hear that from some clients. And so I would love to hear your perspectives, you know, on, you know, is it financially motivated? Is it strategically motivated? A combination thereof. What's your kind of philosophy there at JJ Ventures?
Yeah, so JJDC is certainly a strategic investor, and that's been the case since about 2012 when J&J created J&J Innovation globally, has a brand to house all the innovation activities focused on the external environment. Prior to that, we were strategic investors, but we also did about 20-25% of our portfolio in what we call white space, so areas that were adjacent to areas that J&J operated in. And we may revisit this, right? Because we look at ourselves every 5 to 7 years and say, you know, are we doing the things that is needed for J&J to be a leading healthcare company over the next few decades? With respect to your specific question, as a strategic investor, do we look at onboarding everything we invest in? The answer is the day an investment is made, it is strategic. That is, it is aligned to something on the R&D side or on the revenue side in some of our businesses. However, the reality with startups is they evolve and they change their business plan based on science or market feedback or whatever the case may be. Also, J&J evolves its strategy, right? And most of these investments, especially on the biotech side, have a residence time of about 7 years. So there is a meaningful probability that there is a mismatch over 7 years of what the strategic fit of something is. So for us, success is not measured on onboarding every deal we do. That's an impossible ask because truly, if you're doing venture investing, you know, failure is part of the game. Otherwise, we are not taking enough risk. We should be investing in the bond market, right? So that's where you don't like losses. But having said that, what we are looking for is probably somewhere of the order of 1 in 5 of our companies end up doing something with J&J. And on the biotech side, we are not looking for acquisitions, honestly. It's not possible to acquire platforms and you know, capture all the value. We are looking more to license an asset and so on. So if you're looking at data science, we are looking to partner with these companies on accessing data sets or their technologies. But many of the data science and machine learning companies truly will have the most value if they are not part of any of the larger healthcare companies, but are probably part of some other sort of entity which is motivated to work with everybody and share the data as a sort of common good, you know.
Yeah, Jasper, do you care to share any views on kind of this?
Yeah, I mean, this is exactly you would get the same answer from our end. We are first and foremost strategic, but also realize that corporate strategy changes typically every 2-3 years, and startup strategy probably changes even faster. So to be able to find that match in changing environments is simply up to chance. And I think there was recent research being done on the success of corporate venture funds and the number of acquisitions that they did, and it actually turned out that actually most of the corporate VCs, their parent companies, do not acquire the target companies. And I think for us it's the same way. What we do is We do investments because they are strategic to the business of Merck, which means that they can be paradigm shifting. They are not ready right now for licensing or acquisition, but they are the type of investments where we would like to use venture money and we like to use equity as a tool to become close. To become close in a very ethical way with a very strong firewall between us as an organization and the broader Merck organization, but obviously with the opportunity to put people in touch and to put a CEO in touch with your head of oncology, because it's a portfolio company of ours, is a very powerful tool to create a much stronger bond and a more open conversation than you would otherwise have. And I think that's where we can really show our value. But at the same time, we have an evergreen structure. And also, which means that we have that double bottom line. And I also firmly believe that you're not able to be a good strategic investor if you neglect the potential for returns. Because you are tied in a universe with co-investors that are investing for profit. You're tied into a universe where you want entrepreneurs to really work as hard as they can for the biggest exit possible. And if you're clearly misaligned with that, you are going to run into big issues when you start to refinance companies, when you do follow on companies, you will quickly be seen as a not so reliable partner. And the same goes if you're not strictly adhering to a firewall policy, to a very ethical way of investing and not treating. And this is something, and this is where it gets very interesting because I see a lot of examples from out of different sectors. Because with Ventures, we do investments in so many different sectors. I see examples from out of the semicon industry, for instance, where corporate investors typically are, I would say, where there is less distinction between the corporate venture arm and the M&A arm of a corporation. And that, of course, leads to a completely different dynamic where you have to be very careful.
So, Matt, I may want to add the following as well, right? At the end of the day, corporate venture groups, if they have to survive over decades, and we have been around, 47 years, financial returns are important because these corporations are for profit, right? So over the long run, nobody is going to run a venture arm which is net, a loss center, right? So that's one point. The other point I think where I need to mention is if a corporate venture capital group has the market reputation of really not being focused on the fiduciary responsibilities, which is what Jasper was saying, has an investor in these companies, if you're taking board seats, or even if you're not taking board seats, maintaining the conflicts and confidentiality appropriately, then the best deal flow will disappear over time to that group.
Mm-hmm. Yeah, no, most certainly. It's just fascinating. And the notion of firewalls, I can speak from when we are representing companies on the company side, and they're talking about strategic investors. I mean, this is always part of the conversation, right? It's a different beast, and it's an important one. And so you have the resources, just as Jasper said, being able to speak with the head of oncology or whatnot. I mean, they're invaluable, like resources that cannot be replicated in any other scenario. But at the same time, then the founders of these startups are also concerned about things like confidentiality, leakage, et cetera. And so obviously we're talking with two of the foremost leaders here. And so we obviously know that those are preeminent concerns for them as well. I'm really interested in this topic of how you work together, because one of the things that we see, particularly in life sciences, there are only so many corporate investors out there looking at different markets that have the heft to have a venture arm or to be doing venture investments and have the wherewithal to buy these companies. And so it is common to see, reputation matters, right? It's a small sandbox. We tend to see the same players kind of again and again. And I'd love to hear, Jasper's mentioned a syndicate before, and obviously our two esteemed panelists are working together on a couple portfolio companies. But I would love to hear kind of that interplay of working, either being the sole source, the sole strategic, versus being part of a syndicate of strategics. And then, you know, maybe they're all looking at different indications or different aspects of the data or whatever's coming out of the startup. And then also the interplay with the financial sponsors, okay? Because again, Jasper mentioned that as well. It's an important cog in the wheel, and very frequently we'll see a setup where there's a startup with, you know, one strategic investor and then a financial investor as well. So maybe would you like to speak to the kind of that dynamic of how you work together, maybe starting with Jasper with kind of syndicates and then a mix of financial and strategic investors?
You know, it's a great question, and it's one that we indeed get quite often. I think on our end, we have a very simple philosophy, and that is make sure that, first of all, that you get the right skill set in your investor base, and you get the right amount of capital in and the right amount of security, that you will be able to have at least 40% of capital or 50 secured for the next round of investing. And that also comes from the times when when capital was a little bit less abundant than today. But I think that is still something that's very important. And with skill set, I mean bringing in the necessary skill set to focus on value creation, but also the necessary skill set that can actually allow you to speak to senior people with lots of drug discovery experience. For instance, when you talk about drug discovery companies, and this is where actually we have very good experiences with mixed syndicates of corporates and non-corporates. And we actually find that the corporate investors that we prefer to work with, like JJDC, SO1, Pfizer Ventures, Novartis, etc., are very professional, highly skilled investors that also bring that additional skill set to the table, which is great connections inside of their R&D organization and being able to open their R&D organization. And there is a strong basis of trust, I think, between these investors, but also between the financial investors that we all work with. So for me, the ideal syndicate is a mixture of corporate and financial. We do have quite a lot of deals where we're the only strategic investor, but at the same time, I don't see that as a negative. The only thing that I see as a negative sometimes is that there might be a tendency to exclude corporate venture funds from some of the M&A or licensing discussions. And I think that is actually value destroying, because the corporate venture guys are typically also the guys that have quite some experience with licensing deals and may have more experience in doing and running M&A processes than some of the more financially oriented investors. So this is always where we try to make sure that we get those conflicts of interest. If they are there, we get them out up front, so that everyone that has really something to add to those discussions is also able to actually add them.
Let's see, Asish, do you have anything you'd like to add to that?
No, I think that was a very good summary. And the last point there on, financial investors, when there is an M&A offer for the company, excluding the corporates. Now, if there are conflicts and if that corporate is involved in the process, clearly their representative on the board needs to be recused. But in general, I agree with Jasper that compared to a lot of the financial investors I work with, I see a lot more of BD and M&A numbers and the thinking why those numbers make sense to a large company, while many of the financial investors have a very myopic view of cash on cash and IRR and are really not focused on, is this drug actually going to reach the numbers they project? Because it's easy to, at an early stage, come up with numbers because you don't have the data to support a lot of it, right? Only when you have phase 2B data can you really say how much is a drug likely to sell in the market. So on that point, I agree that the industry probably needs to improve its practice where they can actually benefit a lot by working with non-conflicted corporate investors to maximize returns.
Yeah, it's fascinating. I mean, especially in life sciences, I mean, there's no one that knows these markets better than the two of you and your respective teams. And there's always a bit of gamesmanship in the M&A process, right? And so You know, really interesting facts. Now, I do just want to remind the audience, I guess I lost track of time a little bit. We got about 5 minutes left. So if there's a question, you know, you always wanted to know, but we're afraid to ask. We're on Zoom. We can't see you. So this is a good time to ask that. And so, you know, I think but barring that, we'll kind of start trying to wrap things up. You know, we've heard a lot of really fascinating things. I think maybe one thing, Asish, maybe we'll start with you, is you know, one of the great benefits, just as you alluded to in the M&A process, no one knows this stuff better than you guys, and we've also talked about kind of the separation of church and state, conflicts of interest. So how does J&J kind of navigate that? You know, in a classic example that I see is, you know, when you're invested, when a company like J&J is invested in a startup, J&J has resources that they just don't, and a lot of times that might be regulatory, right? You know, there's no better teams than the teams at Merck or J&J at navigating the regulatory framework, you know, domestically in the U.S. or across the world. So a lot of times we'll see companies say, hey, how do we access your resources there? And there's always concerns about IP leakage, about tainting programs, things like that. So do you have any thoughts on what best practices might be for kind of actually bringing to fruition the holy grail of marrying both the resources and expertise of the strategic with the needs of the startup?
So putting a plug in for my colleagues at Johnson & Johnson Innovation, you know, we have opened innovation centers globally in Silicon Valley here, in Boston, in London, in Shanghai. We also have satellite folks in places like Sydney, Tokyo, Singapore, and so Tel Aviv, and so on. And, you know, a lot of my colleagues are actually plugged into the business. And what I do is work with them and the startups and under independent CDAs, independent of JJDC, for getting some of these insights, especially regulatory insights on the medical device side, where the path has become longer and more complicated, and also getting feedback sometimes from payers in areas like consumer healthcare or in medical devices where, you know, there's been a lot of change in what payers are willing to pay for is something that has been very useful to our startups. And we do most of this completely pro bono, right? And we have put in mechanisms to do that as seamlessly as possible with the innovation centers now.
Yeah, and this very much echoes, I would say, our experience. Every single interaction between our portfolio companies and Merck is guarded by its own separate CDA. And I think that's one very powerful way to make sure that there is no IP leakage, there's no tainting of programs. And also, typically, this happens at a fairly senior level. So these people are aware of what they cannot say, what they can say, and what they cannot ask, and what they can ask. I think another layer, and this also very much mirrors also the experience I actually have with JJDC on the board of one of our companies, is when these kind of interactions are being set up or are being offered, we simply discuss it also at the board level. And we discuss with the full board and we say, hey, we have this and this assay specialist that can actually work and help the company to tease out some of the issues with the assay conditions. Do we think it's a good idea? And if the answer is yeah, sure, let's go for it, then of course you immediately got that clearance. But the key is to be transparent about it and to really offer it. This is a service that we offer. This is value add, and I think this is also how people typically perceive it.
Well, thank you so much. I think we're very close to the top of the hour, and you know, I don't know if it's time to close it out, James or Kaloyan. Let us know. Give me the high sign. Should we wrap up here? All right. Well, I'll let James and Kaloyan to take us out, but I want everyone at home to please make sure you give Jasper and Asish a really big round of applause. Okay, they're just wonderful, and another huge, you know. So you guys are getting a standing ovation right now. Just trust me on that. And obviously a huge thank you to GCV for putting this together. I think this was just fascinating stuff and hopefully very helpful to to everyone else's respective businesses. But with that, maybe I should stop talking, and I'll turn it over to the GCV team.
Thank you so much for moderating this this really fascinating and insightful panel, Matt. And big thanks to Jasper and Asish once again on behalf of Global Corporate Venturing for their participation in this webinar. Jim, I'm not sure if you have anything to add before I close off completely.
No, I think that's it. We'll be doing the IT sector next month in the July issue, so that will be an exciting one. So we're looking forward to that. And then obviously the GCV Digital Forum, we're already preparing for that on the 29th of September. We're delighted that Jasper's CEO, Stefan Oshman, will be sort of joining to give a keynote alongside some others. So we'll be looking across different sectors, but pulling together who's who of the ecosystem. We were delighted that the first digital forum earlier this month had 600 registered attendees. It was $10 trillion in aggregate annual revenue. So it was fantastic to have the sort of thought leaders be able to sort of join and share. So looking forward to that. And I'll pass on my final thanks to you, Kaloyan, for doing it, and obviously everyone else for being able to join. Thanks all.
Thank you, Jim, and thanks once again to everyone. Stay tuned for the next webinar. I hope you've enjoyed this one. The recording and the slides will be made available as soon as possible. And as Jim said, stay tuned for the IT sector webinar next month. Finally, I would just like to say, stay safe and have a good day, afternoon, or evening, wherever you might be in the world. And goodbye.